Hello everyone, my name is Siddharth and today I'll be talking about the RBI Monetary Policy Committee and post-COVID economic recovery. So without further ado, let's get to it. Why are we discussing the MPC right now? What has happened that has made the MPC come up in news again? The MPC meets once every 2 months, most recently on August 6th. In the August meeting, they voted to keep the policy rate unchanged at 4% and keep an accommodative policy stance. The decision was taken on a 5:1 voting ratio. The dissenting vote was cast by MPC member Jayant Verma. Mr. Jayant Verma questioned the easy money policy of the RBI considering the CPI and WPI have been consecutively increasing over the last few quarters. This put the spotlight on the MPC, and which is why it is in the news again. Let's have a brief overview of how this lecture is going to proceed. So initially, we will discuss the powers of the RBI and the Monetary Policy Committee in inflation management in India. After that, we will discuss on what do we understand by the monetary policy, what are the major monetary policy tools available to the MPC and the RBI in India, what is the structure, role and responsibility of the Monetary Policy Committee. After that, we will get to COVID-19 and the induced economic stress, the steps taken by the Government of India and the Reserve Bank of India, post-COVID economic recovery and the second wave induced stress, the MPC and COVID-19 tussle regarding the policy rate, and then we will discuss the way forward. Monetary policy. What do we understand by monetary policy? Monetary policy refers to the control of money supply in an economy by a nation's central bank. Such a control of the money supply is pursuant to any of the following objectives: inflation targeting, maintaining price stability, predictability of exchange rates, and sustainable economic growth. Monetary policy in India is set by the RBI under powers given to it by the RBI Act of 1934. Monetary policy is not to be confused with fiscal policy. Fiscal policy includes monetary policy and goes beyond its scope to include other elements such as taxation, budget, income and expenditure policies. Such monetary policy is generally of two types: expansionary monetary policy and contractionary monetary policy. Expansionary monetary policy or cheap money policy is related to increasing the supply of money in the economy. Increasing supply of money leads to increased liquidity and velocity of money in the market. This eventually leads to increasing disposable income in the hands of people. The objective of such easy money policy or cheap money policy is reflation and economic growth. Contractionary monetary policy, on the other hand, relates to decreasing money supply in the economy. Decreasing money supply leads to reduced liquidity in the market and eventually decreases the disposable income in the hands of people. The objective of such dear money policy or tight money policy is to create a condition called disinflation, that is, controlling or reducing the rate of increase of inflation in an economy. Monetary policy authorities all over the world generally use some monetary policy tools to achieve the targeted goals. Such monetary policy tools can be categorized under two broad categories: indirect or quantitative policy tools. Such quantitative policy tools affect the overall supply of money in the market. Since they have no specific control on the money supply in the market, efficient transmission of policy is a problem when it comes to quantitative policy tools. Such policy tools include policy or repo rate, bank rate, marginal standing facility, cash reserve ratio, and statutory liquidity ratio, etc. Then we have direct or qualitative policy tools. Such qualitative policy tools affect specific supply of money in the market. Since they have specific control, they have a direct impact on available sectoral credit. Qualitative policy tools include moral suasion by the central bank, margin requirements for loans, credit rationing for different sectors, etc. Amongst the various available policy tools, repo is the most popular policy tool used. Hence, policy rate in India generally refers to repo rate. Repo stands for repurchase obligation. That is, repo rate is the rate at which the RBI lends money to banks for a short period in exchange for some securities pledged by the banks with the RBI. There is a repurchase obligation on these banks to buy back these securities at the end of the period. Repo rate is the flagship monetary policy rate published by the RBI. In fact, repo is so important that repo is also the anchor for reverse repo rate and marginal standing facility rate in India. The RBI has effectively used policy rate to target inflation in the Indian economy. The impact of policy rate on supply of money in the economy is disinflationary if it is increased and inflationary if it is reduced. That is, when the RBI increases the repo rate, banks get money at a higher interest rate from the RBI. Banks lend this money to customers at a higher interest rate. Therefore, since the rate of interest increases, it tantamounts to dear money policy. It reduces the liquidity of money in the market. Therefore, less money is chasing the same amount of goods, which is equal to decrease in inflation. The corollary is true if the RBI decreases the repo rate. That is, banks will now get money at a cheaper rate of interest. They will lend this money to customers at a lower rate of interest. Therefore, there will be an increase in liquidity in the market. There will be more money chasing the goods and services, and there will be an increase in inflation in the economy. To improve this policy rate transmission, the RBI has now even made repo an anchor for bank interest rates, specifically called as RLLR or repo linked lending rates of banks. Earlier, the prerogative of setting the policy rate was only of the RBI governor. But based on the impact and importance of the policy rate, various committees in the past recommended that the policy rate should be rather decided collectively to ensure accountability. Thus, when the Urjit Patel Committee recommended the setting up of a monetary policy committee, the government agreed and implemented the committee recommendations. The MPC came into force on 27th June 2016. One of the major reasons for implementing the committee recommendations and creating a monetary policy committee was the policy rate tug of war between the RBI and the Ministry of Finance. The RBI, tasked with inflation targeting and macroeconomic stability, wanted to maintain a high policy rate. The Ministry of Finance, on the other hand, tasked with industry lobbyists and populism, wanted a low policy rate. Hence, the Ministry of Finance was more than happy to regulate the policy rate powers of the RBI governor with the setting up of the Monetary Policy Committee. Monetary Policy Committee. The MPC is a 6-member committee with the RBI governor as its ex officio chairperson. The MPC has 3 members from the RBI and 3 members nominated to it by the Government of India. The committee meets 6 times a year, that is once every 2 months. It is tasked with setting the policy rate, and all its decisions should be taken by a majority vote. In event of a deadlock, the RBI chairperson has the casting vote. The MPC adjusts the policy rate as per the macroeconomic conditions of the time. The primary objective of the MPC is inflation targeting. Such inflation target ranges are set by the central government for different periods. For example, the inflation target range for the period of 2021-2026 is 4% plus or minus 2% as recommended by the Urjit Patel Committee. The inflation anchor is CPI, the Consumer Price Index. Consumer Price Index is fairly different from WPI or the Wholesale Price Index. WPI, as the name suggests, indicates inflation in the wholesale price of goods. The WPI is published by the Office of Economic Advisor, Ministry of Commerce and Industry. WPI, most importantly, does not include services. The CPI, on the other hand, indicates the inflation in the retail price of goods and services. Yes, CPI includes certain services in its basket. The CPI is published by the Central Statistics Office. CPI may be further subdivided into headline inflation and core inflation, wherein core inflation is headline inflation minus inflation in the prices of food and fuel. The inability of the MPC to maintain the inflation in the target range of 2 to 6% is considered as a failure. In such a condition, the MPC is supposed to issue a report to the government stating the following: the reasons for the failure to achieve the target, the proposed remedial actions, and an estimate of the time period within which the inflation will again be achieved in the target range. Now we move on to the next section: inflation, COVID-19, and post-COVID economic recovery. COVID-19 induced economic stress created a situation wherein, for the first time, the MPC was headed towards a failure. Lockdown 2020 had a deep impact on the global economy in general and the Indian economy in specific. Sectoral closures, travel bans, the great reverse migration led to entire supply chains getting disrupted. This led to supply issues and raw material shortages on the one hand, demand slowdown due to income insecurity on the other. To overcome this economic disruption, the Government of India went into overdrive in the unlock phase. A fiscal stimulus package was released. An easy money policy was adopted to ensure swift demand recovery. The government even launched new infrastructure projects and capital expenditure, directed departments and public sector enterprises to clear vendor payments on a priority basis, etc., to get the wheels of the Indian economy turning. The RBI too took an accommodative monetary policy stance and even allowed for COVID emergency credit lines wherein existing borrowers were allowed an additional loan facility to overcome short and medium term cash flow problems. Such an expansionary policy led to restoring demand to a certain extent, or at least that's what consumer confidence surveys by the RBI showed. Yet, the supply side issues were yet to be resolved, leading to something called as cost push inflation. Cost push inflation is when there is a rise in the prices of goods and services due to an increase in the cost of the raw material, an increase in the cost of the factors of production, or an increase in the cost of the services consumed. For example, the steel and cement sectors are having their best days due to an increase in the global and domestic prices, leading to inflationary shocks to the construction sector. So much so that CREDAE has even complained to the Government of India against such price shocks. Thus, the construction sector is a very nice example of cost push inflation in 2020. Even before the supply side issues could be resolved, India got hit by the second wave of COVID-19 in 2021. Thus, there were localized lockdowns in a staggered manner across the country, leading to economic disruptions. The rising prices of crude oil only added fuel to the fire. The consequence was a reinforcement of the COVID-19 induced economic distress of 2020. Again, demand and household consumer confidence surveys showed signs of a slowdown, creating stagflation-like conditions. Let's try and understand what do we mean by stagflation. Stagflation is a curious situation that is created when, on the one hand, the economy is suffering from cost push inflation, and on the other hand, there is a demand slowdown and acute unemployment in the market. Thus, a vicious cycle is created wherein cost push inflation leads to demand slowdown, leads to unemployment, leads to further cost push inflation. This cannot be tackled by simple counter-cyclical measures by the MPC. Noted economists like Kaushik Basu recently expressed that India is now suffering from stagflation. Thus, stagflation creates a dilemma wherein the solution to economic slowdown is an expansionary monetary policy, that is, increasing government spending, capital and revenue expenditure, RBI's easy money policy, and an accommodative policy stance. While the solution to inflation is a contractionary monetary policy, wherein fiscal discipline and consolidation, reining in government revenue and expenditure, RBI's dear money policy, and tight policy stance are required. This leads to raising an important question: whether or not to raise the policy rate. When the MPC maintained its accommodative policy stance in August 2021, Jayant Verma cast his dissenting vote. Jayant Verma dissented on the following counts. Maintaining an accommodative policy stance for a prolonged period can cause overheating of the economy due to excess liquidity and inflation. Besides, COVID-19 has created an exceptional environment leading to a breakdown in economic and statistical relationships. MPC thus must be agile and flexible as opposed to inert and hopeful that the crisis will fade away. Also, an easy money policy for a prolonged period of time might cause galloping inflation like in 2011-12 in the Indian economy, hurting rather than reviving the economy. The primary task of the MPC is inflation targeting, and its inability to rein in inflation might lead to a loss of credibility. While there is some truth in the dissenting voice of Jayant Verma, the MPC chose to prioritize economic growth over inflation targeting. Based on the rate of inflation, inflation can be categorized in various types. There is creeping or mild inflation, that is 3% a year or less. This form of inflation is healthy for the economy because it promotes economic growth. Next, we have walking inflation, which is in the range of 3 to 10%. This form of inflation is healthy for the economy yet borderline because it erodes the monetary value of currency. Then we have double-digit inflation or galloping inflation. Galloping inflation is definitely detrimental for the economy. It leads to a rapid erosion in the currency value of the economy. Besides, it reduces the global standing of the economy. Lastly, there is an extremely high rate of inflation called hyperinflation of 50% and more. Hyperinflation leads to a complete loss in confidence in the local currency and the economy. For example, Venezuela was suffering from hyperinflation in 2018 and 19. Zimbabwe once suffered from hyperinflation, which eventually led to abandoning the local currency and adopting the US dollar for transactions. Thus, the question of inflation is also a very important question not to be stifled with or ignored. What then could be the way forward? Extraordinary circumstances call for extraordinary measures. Stagflation-like situations cannot be dealt with simple countercyclic policy rate measures. The RBI and the government must thus look beyond policy rate to tackle the current issue. The government must work on restoring the supply chains so as to reduce the cost push inflation. Reviving internal and external demand to boost industry confidence is very important. Fiscal policy should support monetary policy to ensure effective policy transmission. Lastly, and most importantly, an accelerated pace of vaccination is important to avoid any further future COVID waves. The macroeconomic fundamentals of the Indian economy look more promising today than ever before. The muted impact of the second wave of COVID-19 on the Indian economy bears encouragingly on us. If the bull run of the stock market is any indicator, investors haven't lost confidence in the Indian economy just yet. Thus, economic growth must be prioritized at all costs. It is the only way forward. That's it for today then. Thank you and have a nice day.